Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and thumple way.
Thanks for having me. I'm really excited to dig into this one today.
Yeah, it's going to be a good one. So today we are looking at this massive financial optical illusion, and it is currently fooling like almost every major central bank on earth right now.
Oh, absolutely. It's a huge blind spot.
Right, because you see gas prices spike at the pump, or you watch your grocery bill tick higher, and you just naturally assume that, well, runaway inflation is here to stay.
Yeah, that's the gut reaction for sure.
Exactly. But according to recent economic analysis, we actually have it completely backwards. The data strongly suggests that these sudden energy shocks are, they're actually a massive deflationary time bomb.
Yeah, and it completely upends how we are traditionally taught to view the economy. I mean, we are so heavily conditioned to see a higher price tag on, one essential commodity, right? Like oil. And we immediately diagnose the entire global economy with a systemic inflation problem.
We just panic.
We do. But when you step back and look under the hood at the actual mechanics of credit creation and household income and aggregate global demand, the machinery is actually moving in the exact opposite direction.
Okay, let's unpack this, because we really need to dismantle this classic assumption that a spike in one essential item just automatically equals economy-wide inflation.
It's a really important distinction to make.
Right. So let's use a very relatable, everyday scenario for you listening at home. Imagine your household budget.
Okay, keeping it simple.
Exactly. After all your fixed bills are paid, rent, utilities, insurance, let's say you have exactly $100 a week set aside for discretionary spending.
Your fun money.
Yeah, your fun money. This is your money for eating out, maybe buying a new pair of shoes or going to see a movie. Now, because of a sudden global supply shock, the cost to fill up your gas tank just jumps from $40 to $80 overnight.
Which, by the way, is the precise nature of the energy shock we're seeing filtering through the markets today.
Right. Now, when that gas pump hits $80, your boss doesn't magically call you up and say, hey, I'm increasing your paycheck to cover the difference.
I wish.
Right. Your wallet doesn't physically expand. You still only have that same $100 pool of discretionary money.
Yeah, the math doesn't change.
So to pay that extra $40 just to get to work,
Yeah.
you have to actively destroy $40 worth of spending somewhere else in the economy.
Yeah.
You cancel pizza night.
Yeah.
You put the new shoes back on the shelf. You substitute cheaper items at the grocery store. This is what economists call a relative price shock. The price of gas went up relative to the price of pizza, but your total spending power remained entirely static.
What's fascinating here is that true systemic monetary inflation requires a very specific mechanical engine to keep it going. It requires expanding credit and expanding income.
So you actually need more money in the system.
Exactly. For prices across the entire economy to rise continuously month after month, there fundamentally has to be more money actively chasing those goods.
Right.
And money isn't just, the physical cash a central bank prints. In our modern system, money is created when banks confidently issue new loans or when businesses expand their operations.
Or when people are just swiping their credit cards left and right.
Right, when consumer credit flows freely. So an energy shock, without that corresponding extra money in people's pockets, simply acts like a giant unavoidable tax.
It just drains liquidity out of the system.
Exactly. It drains liquidity. And when millions of households simultaneously cancel pizza night and, stop buying shoes, the total aggregate demand in the broader economy structurally shrinks.
Because the pizza place loses revenue.
Right, so they hold off on hiring a new delivery driver, and the shoe manufacturer scales back factory production.
The domino effect.
It is. That cascading effect is a massively powerful deflationary force.
And looking at the data, this isn't just some abstract academic theory. We can see the exact same mechanical draining of demand happening with other economic policies too.
Oh, absolutely.
Like if we look at the current trade policies under the Trump administration, where there is a massive focus on tariffs. And to be clear, we aren't taking any political sides here. We're just looking at the mechanics of the policy.
Right, just the math.
Exactly. A comprehensive study by the Federal Reserve Bank of San Francisco analyzed 150 years of tariff data. And tariffs function mechanically just like an energy shock.
They really do.
They artificially raise the price of imported goods at the register without raising the consumer's wages. And the data shows The tariff increases predictably shrink aggregate demand.
Because people just buy less.
Right. They ultimately lower overall inflation by cooling the entire economy down. Because, like you said, they act as a vacuum, just sucking purchasing power directly out of the consumer's wallet.
Yeah, the underlying mechanism is virtually identical. A sudden external spike in unavoidable costs, whether that's engineered by an energy bottleneck or a government tariff. It creates immediate uncertainty and destroys consumer demand.
Right.
In fact, a February 2026 paper from the National Bureau of Economic Research corroborates this. They demonstrated that this specific deflationary pattern following supply shocks has been like the dominant feature of the post-war economic era.
Wow, really?
Yeah. When purchasing power is drained to pay for necessities, the broader economy eventually just suffocates and cools.
Okay, but I have to push back on this a little.
Go ahead.
If this demand destruction is actually happening, if millions of people are buying fewer pizzas and fewer shoes, why does the official inflation rate, the CPI, still look like it's screaming higher?
That is the million-dollar question.
Right. I mean, if the economy is suffocating, why are the alarms ringing on every single financial news channel?
Well, this comes down to the actual mechanical construction of the Consumer Price Index.
The CPI.
Right. The CTI is not a dynamic, real-time monitor of your personal day-to-day spending substitutions. It is a very rigid, fixed basket of goods.
Okay.
And in that mathematical basket, energy and food are assigned massive, heavily weighted chunks. So in the short term, specifically the first 1 to 6 months of a supply shock when oil prices surge, the headline CPI undeniably spikes.
Ah, I see. It's like placing the economic thermometer directly next to a space heater.
That is a perfect analogy, yes. It registers a massive localized fever even while the rest of the house is absolutely freezing.
So the index mathematically assumes you're still buying the exact same volume of goods, just at the new inflated prices. It completely ignores the fact that you stopped going out to eat so you could afford the gas.
Precisely. It takes months for that lagging data to catch up to the reality of consumer substitution.
Which explains the panic.
Exactly. And recent macroeconomic analysis highlights both the IMF and the European Central Bank warning about this very trap. They note that energy shocks predictably raise short-term inflation metrics, but they aggressively damage actual economic output.
Right. Because nobody's buying anything else.
Yeah, and you can actually see this cognitive dissonance in the ECB's own recent policy moves.
Oh, how so?
Well, they simultaneously raised their 2026 inflation forecast from 1.9% up to 2.6% due to energy costs.
Okay.
But at the exact same time, they aggressively cut their actual economic growth projections.
Wow.
Yeah. They mathematically recognize that the inflation is a short-term illusion caused by a supply bottleneck, not the result of a wealthy, booming consumer base demanding more goods.
Here's where it gets really interesting. Because if you are managing a portfolio, or even just your retirement account, understanding this timeline mismatch is basically the whole game.
It really is.
The first 6 months of an energy shock look and feel like a raging, unstoppable inflation fire. But the 6 to 18-month window, that is where the demand destruction finally bleeds into the hard data.
Right. The reality sets in.
Exactly. Real incomes drop. Consumers rely on credit cards until they hit their limits, and then credit creation shrinks. Businesses see their profit margins compress, so they halt capital investments.
They stop expanding.
Right. And suddenly, disinflationary pressures completely take over the narrative. It is short-term pain, followed by a severe midterm economic drain.
And that psychological trap, that fixation on the short-term thermometer, is exactly what is causing such violent structural turbulence in the financial markets today.
Because everyone is reacting to the space heater.
Exactly. Investors and central banks are staring at that localized CPI spike, and they're panicking. They are treating a supply shock as if it were a demand boom, which brings us directly to the absolute chaos currently unfolding in the global bond market.
Yeah, let's talk about that fallout, because the bond market is currently flashing bright red right now.
Yeah, it's intense.
According to the data, U.S. 10-year Treasury yields recently hit 4.38%, which is the highest level since last summer. And at the exact same time, 30-year fixed mortgage rates jumped up to 6.22%.
Which is painful for anyone trying to buy a house.
Oh, incredibly painful. And for the beginners out there, think of interest rates as the fundamental gravity of the financial world.
I like that.
Yeah, when interest rates go up, the gravitational pull gets heavier, and it mathematically pulls down the valuations of everything else, especially housing and the stock market.
If we connect this to the bigger picture, we really have to distinguish between a good yield rise and a bad yield rise.
Okay, what's the difference?
Well, a healthy, good rise in yields happens when the economy is booming. Corporations are borrowing heavily to build new factories, wages are rising, and the demand for capital is high because the future looks incredibly profitable.
So yields go up because everyone wants money to grow.
Exactly. But that is absolutely not the mechanism driving today's market. Yields are currently surging because of war-driven inflation fears.
So when my pizza and shoe budget gets wiped out by a trip to the gas station, the central bank's response is to make it harder for me to buy a house too.
Pretty much.
Very helpful of them.
Yeah, it highlights the exact policy error we are discussing today. With geopolitical tensions threatening major energy infrastructure in the Middle East, Brent crude oil recently hit the $112 to $113 range.
This is massive.
It is. We haven't seen levels like that since 2022. And oil is the lifeblood of global transport and manufacturing. Central banks look at that $113 barrel of oil, they look at the corresponding short-term CPI spike, and they are terrified of repeating the 1970s.
They're fighting the ghost of inflation.
Exactly. Because of that fear, they are backing away from cutting interest rates. They're intentionally keeping the financial gravity artificially heavy right at the exact moment when consumer purchasing power is already collapsing.
Wow.
And this leads to a brutal mathematical reality for the stock market. When U.S. Treasury yields rise, the discount rate that Wall Street uses to calculate the present value of future corporate earnings rises too.
Right, because why take a risk on a stock if you can get a guaranteed return from the government?
Exactly. Suddenly, a tech company promising massive profits 10 years from now looks mathematically worthless today because investors can just grab a risk-free 4.4% yield from the U.S. government.
And this artificially heavy gravity is not contained to just the United States. It is ripping through the global financial system, but it's exposing very different structural cracks depending on where you look.
It's a global problem, yeah.
Right. Like in the UK, 10-year gilt yields recently crossed 5%, hitting highs not seen since the aftermath of the global financial crisis.
That's a huge psychological level.
It really is. And over in Germany, their 10-year yield pushed past 3.025%, the highest since the European debt crisis back in 2011.
Those specific European metrics are flashing a severe warning about fiscal vulnerability. Because remember, Europe and the UK do not produce their own energy.
Right, they have to import it all.
Exactly. They are overwhelmingly reliant on imported oil and gas. So when an energy shock hits, it isn't just the consumer who suffers. Their governments historically step in with massive public subsidies to prevent citizens from, freezing in the winter or going bankrupt.
Which costs a fortune.
A literal fortune.
Yeah.
But if their borrowing costs, those 10-year yields you just mentioned, are simultaneously skyrocketing because of global inflation panic, it creates a terrifying squeeze on their national budgets.
So they have to borrow more money at much higher rates just to keep the lights on.
Right. The bond market starts demanding a steep risk premium just to lend to those governments, questioning their ability to shoulder both heavy subsidies and high interest rates.
And then you look at Japan,
Oh.
which just feels like it's trapped in a completely paralyzing doom loop right now.
Oh, Japan is in a really tough spot.
Yeah, they're finally trying to normalize their interest rates after years of unconventional monetary policy, but they are getting absolutely crushed by imported inflation.
Because they also import almost all their energy.
Exactly. When they try to keep their interest rates low to stimulate their domestic economy, the yen collapses in value against the U.S. dollar. And since global oil is priced in strong dollars, that weak yen just makes the oil they desperately need exponentially more expensive to import.
It is a textbook currency doom loop. I mean, to defend the yen and lower the cost of imported oil, the Bank of Japan has to raise interest rates.
But raising interest rates crushes their heavily indebted domestic corporations.
Exactly. They are caught between destroying their currency or destroying their domestic growth. There's no easy way out.
And the collateral damage of this global gravity hits emerging markets with incredible speed. I mean, looking at the latest data, Indian mutual funds just dumped a record 356 billion rupees in government bonds.
That is a staggering amount of capital flight.
Right. This isn't just a slight portfolio adjustment. When the U.S. 10-year Treasury offers a risk-free return of almost 4.4%, global capital aggressively flees emerging markets like India to grab that safe U.S. yield.
It's a giant vacuum.
It is. And to prevent their local currency from collapsing under that capital flight, institutions in India have to aggressively dump their own government bonds, which drives their local borrowing costs through the roof and crushes local liquidity.
Yeah.
And even in a place like New Zealand, where the domestic economy is objectively weak right now, Their 2-year swap rate suddenly jumped nearly 0.6%. The global gravity is indiscriminately crushing their borrowing costs, completely divorced from their actual local economic health.
This raises an important question.
Okay.
If global central banks are keeping rates universally high to fight what is essentially a localized energy bottleneck, and traditional safe haven government bonds are suddenly dropping in value and acting like volatile risk assets.
Right, because yields are spiking.
Exactly. What is the actual playbook? Because simply buying a broad index of global bonds and closing your eyes is clearly a recipe for severe capital destruction right now.
So what does this all mean? Like, if you are listening to this right now, managing your own retirement account, looking at your 401k, how do you actually protect yourself against this bizarre collision of short-term inflation and mid-term deflation?
Well, based on the data and recent macroeconomic analysis, there are 4 highly actionable strategies you can implement right now.
Okay, let's hear them.
First, you have to actively manage your duration.
Duration, meaning how long your money is locked up in a bond.
Exactly. It measures how sensitive a bond's price is to changing interest rates. When the analysis says manage duration, it means look at your portfolio today. If you are holding massive long-term bond ETFs hoping they will act as a traditional safe haven, you are standing directly in the blast radius of this inflation panic.
Because as yields go up, the price of those 10-year and 20-year bonds drops severely.
Exactly. You need to pivot to short-term paper. High-quality, short-duration bonds and cash equivalents. You want to defend your principal and clip a decent yield while the bond market sorts out this volatility.
Okay, so get out of the blast radius, pivot to short-term paper to survive the gravity spike. What's the second strategy?
Second, you must differentiate geographies. Do not treat global bonds as a single uniform asset class.
Right, because everywhere is facing a different crisis.
Exactly. As we just detailed, the U.S. is dealing with discount rate pressures crushing valuations. The U.K. is facing serious sovereign fiscal risks due to energy subsidies. Japan is fighting a currency intervention doom loop.
Right.
You have to treat U.S. Treasuries, European debt, and emerging market bonds as completely isolated tools with wildly different risk profiles.
Makes sense. And regarding the stock market, if this energy shock is actually draining consumer wallets and cooling aggregate demand, how does that change the equity selection process?
That is the third critical takeaway. Equity selection must prioritize immediate reality over future promises.
Okay.
Because U.S. 10-year yields are sitting above 4.3%, that heavy mathematical gravity aggressively penalizes unprofitable growth companies.
So tech startups burning cash.
Exactly. If a tech company is promising massive earnings a decade from now, but they're burning cash today, the higher discount rate makes them mathematically uninvestable.
Because again, why take the risk when you can get 4.4% risk-free?
Right. You must pivot to businesses with strong, immediate free cash flow. Specifically, look for companies with ironclad pricing power.
Meaning they can raise prices without losing customers.
Exactly. Businesses that provide a good or service so fundamentally essential that they can pass higher costs onto the consumer without suffering demand destruction.
So cash flow is king when gravity is heavy. And the final takeaway is about knowing which metric actually matters right now, right?
Yes. Watch the ultimate leading indicator and ignore the daily media noise. According to the data, the 20-day correlation between the S&P 500 and oil prices is currently sitting at negative 0.89.
Wow. With a correlation of negative 0.89, the stock market and oil are moving in near-perfect opposition.
Exactly. Oil is practically acting as a massive gravity well for equities right now. When oil spikes, stocks tank almost 1-to-1.
It is the single most important mechanical relationship in the market right now.
It really is. If you want to know what global equities or bond yields are going to do next week, do not wait around for the lagging monthly CPI prints.
Watch the real-time price of Brent crude oil.
Watch the geopolitics of global energy supply chains. That localized energy bottleneck is what is driving the fear, and that fear is what is driving every single decision central banks are making.
It all comes back to that initial shock at the gas pump. It forces consumers to cut back, it distorts the fixed CPI basket, it terrifies the central bankers into keeping rates high, and it cranks up the financial gravity on the entire global system.
It's a massive chain reaction.
It really is.
Yeah.
Which leaves us with an incredibly important, lingering question to ponder as we watch this play out.
Yeah.
If this energy shock is fundamentally acting like a tax, if it is already destroying consumer demand and draining wallets, ultimately leading to a heavy deflationary hangover 6 to 18 months from now, what does this mean for the multi-trillion-dollar global transition to green energy?
That is the real consequence here.
Right. If central banks accidentally engineer a severe recession because they are terrified of yesterday's inflation ghost, and global credit completely dries up as a result, do our massive capital-intensive climate goals simply get deferred by a decade? Are we sacrificing tomorrow's energy infrastructure to fight an optical illusion today?
It's a scary thought.
It is. Don't forget to subscribe and hit that like button.